Well, households are bracing for a possible interest rate rise when the Reserve Bank meets next week. The RBA is under pressure to raise rates after higher than expected inflation data revealed annual price rises accelerated at the end of last year.
Well, housing costs driven by electricity was revealed to be the largest contributor to annual inflation in the past 12 months. Economist Nicola Powell says the data should be viewed in context.
We have seen some monthly spikes coming through that inflation data, and I think we do have to consider that the inflation data is a little bit noisy. When you look at the monthly spikes, it happened in July, October, and around December as well, and that is going to stay into those annualised inflations until mid-year. So the spikes really are coming from timing issues. It's things like insurance and energy resets that happened mid-year, and also things like education and services, which reprice later on in a calendar year as well. And then, of course, you've got December, which is travel costs. So that is contributing to these monthly spikes in inflation.
You know, many analysts are expecting a rise of about 25 basis points. Is that in line with your expectations?
Look, I think we have to be realistic here that the RBA are certainly going to be consider whether they will hike rates on Tuesday. You've got the market pricing in, about a third are saying no change and 2/3 are now pricing in that rate hike. And that is because that headline inflation is sitting at 3.8%, and you've got underlying inflation, which is what the RBA's preferred measure is. It takes out some of those volatile components, is at 3.3%. And we still have a tight labour market. You've still got unemployment sitting at around 4.1. So the RBA is certainly going to be considering a rate hike, but they might wait. I think patience is really key here from the RBA, and what we might see them do is actually wait a little bit longer before delivering a rate hike.
But at the same time, there is that argument that if the RBA was to act now, it would be less painful for households rather than down the line when inflation has risen even further, and perhaps we might be in for more than just a 25 basis point rise.
I think that's very realistic. I think we've seen such a change in the conversation around the cash rate. That happened a couple of months ago now, and what we are expecting is a couple of rate hikes to be delivered this year. I think we're all still feeling the pain of the rapid rate hiking cycle we saw back in 22 into 23, and I think we've all learnt from that. And I think all Australians are really just bracing for a rate hike. And I even think buyers out there, new home buyers, will be factoring in the increased costs that could be associated with holding a mortgage.
Are you expecting a spike in mortgage stress for Australian households if we're in for more rate hikes during the course of the year?
So I think obviously households that are new borrowers are much more exposed to changes in the cash rate. And I think it is very important for first home buyers to be factoring in a rate hike or two this year so they can comfortably service a new mortgage. I think when you have high debt and low equity, this is the portion of households that really do struggle. When we look at distress listings across Domain, they still remain very low, but there are certain areas that have slightly higher percentage volumes. Sydney and some suburbs also in Brisbane as well. And I think it is obviously those new home buyers that are going to struggle more so than those that have greater equity.
Nicola Powell, Chief of Research and Economics at Domain. It's always good getting your insight here on Weekend Breakfast. Thank you.
Thank you.